This is Platform Diaries with Shane Williams, who chews the fat with entrepreneurs, startup founders and thought leaders on what it takes to traverse the wall between startup and scale up.
Until recently, the common wisdom was to ensure that your business had 12 to 18 months runway. But the experts are now suggesting that businesses should be holding enough funding to sustain up to 4 years of runway. If that means you need to raise in a bear market, how do you avoid a down round? You're listening to Platform Diaries and I'm your host, Shane Williams. My guest today is Melissa Widner, CEO of Lighter Capital. Melissa is an experienced entrepreneur and investor. She's chairman and co-founder of Heads Over Heels, a board member of the Australian Investment Council, and previous managing director of NAB Ventures. We discuss how the market and thus the funding landscape has changed fundamentally recently, why and how this is causing scale-ups to look for alternative funding models, the concepts behind revenue-based financing, and how you may be able to leverage it to secure more runway while avoiding a down round. I trust you'll enjoy the interview. So, Melissa, thanks for joining me on Platform Diaries.
It's great to be here. Thanks for hosting.
Now, I would really love to jump straight into what I think is going to be a really interesting topic for listeners, particularly given I've recently returned from Sydney at the Blackbird Sunrise Conference, and there's a lot of conversation around, where investment's heading and some cooling of the market and some nervousness around some of the startups that were there looking for investment and so forth. So I might just leap straight into, could you help try to set the context for us around what you're seeing, as in the market? How is the funding landscape changing recently? And, just give us a vibe for what's going on.
Yeah, well, we have been in a long bull VC market really since 2009 until very recently. And while there is a lot of dry powder with venture capitalists, in fact, right now, there's more dry powder with venture capitalists than there ever has been in the history of the world. And dry powder, for people that might not know, that means money venture firms have to deploy that they haven't yet deployed. So, we heard Blackbird they just announced they raised $1 billion fund. If they have already committed 50 million of that or deployed 50 million of it, they have 950 million of dry powder. So while there's a lot of dry powder, there's been a big contraction in valuations. So VCs are sitting on the sidelines a lot more so than they were recently. And what we're seeing in terms of behavior from companies is that they are cutting expenses oftentimes, trying to get as much cash as on their balance sheet as they can. They're being advised by their investors and the market to have anywhere from 18 to 36 months runway on hand. And really for the past decade, the common wisdom, and which was actually fact, was that, if you were performing, you would be able to raise and probably at an up valuation. So there was always going to be money at a higher valuation than your last one as long as you were performing. And what we're seeing today is even companies who are performing well are not necessarily able to raise at an up round or at a valuation higher than they last raised, because they last raised maybe in 2021 or, when the market was a lot hotter.
Yeah, right. And it's interesting that you talk about it being a bull market for a while. So I guess if I was talking to, let's say, investors 18 months ago, a lot of the conversations were, we need constant deal flow. We need to be making investments all the time. You talk about sitting on a significant amount of dry powder and yet pulling back on some of those investments. It seems almost counter to the messaging from 18 months ago from the investment side. Is that fair?
Well, because for VCs, it's, their business model is driven by exits. So when exit valuations have gone down significantly, then you're either going to invest at lower prices or just wait and see what's going on with the market. And I think right now there's a lot of people waiting and seeing, and also thinking that they might have to conserve their dry powder for their existing portfolio companies. Whereas, say, I was a VC for a better part of 2 decades, I could look at my portfolio and know which ones were going to be able to have a fairly easy time raising from other VCs. And I think what I'm seeing today in the market is that venture capitalists are assuming, and I think it's probably a good conservative assumption to make, that the future rounds for their current companies will probably have to come from them, at least in the near term.
Yeah, that makes a lot of sense. And I guess hopefully for people who are, relatively new to the space, that understanding that you're reinvesting in your existing portfolio versus taking on new ones might be a reason to hold back a bit. So maybe that leads me into the next thing, which is this change in behavior, if you like, is this causing some scale-ups to look for, alternative funding models?
Yeah, absolutely. I mean, alternative funding models make sense for a lot of companies in every market. We spoke a little bit before about the fact that while most of the press is focused around venture-backed companies and companies, becoming unicorns and raising big rounds from Sequoia or Andreessen Horowitz or Blackbird, the reality is that it's 1% of companies that seek funding, tech companies that seek funding, that actually get venture funding. So it's a really small percentage of companies that get venture funding. And the other companies have to find other ways to grow. And a lot of times that's bootstrapping, friends and family, or lighter capital provides is revenue-based financing. And that is financing where there's no equity or no control tied to it, but it's essentially a loan that's paid back with revenue from the company until the loan is paid back.
Right. And so, I know, you're probably aware we've had very previous guests on the representing sort of angels and VCs. This sort of feels like another, if you like, opportunity for people who are maybe not going to get the love out of those groups. Could you take us a little bit deeper into how that works?
Yeah. So, and it's not necessarily people who aren't going to get the love out of those groups. There's some companies that are not going to be a fit for venture for a variety of reasons. One, just a very small percentage of companies are a fit for venture, as we said before. But a lot of really good companies, their TAM, their total addressable market, might not be big enough to attract venture capitalists. Venture capitalists have to, for the most part, there's some exceptions, but most of them are looking for only making investments into companies that can pay off their whole fund, because they know most of the companies that they invest into are not going to return their capital. So they're looking for one or two winners out of the fund that can pay off the fund plus a return for their investors. So some companies that don't meet that criteria, this is a good alternative if they meet the criteria that revenue-based financing, that lighter capital has, which is we look for companies with recurring revenue. We look for companies with a minimum of $200,000 in annual recurring revenue, and companies with low customer churn. So we're really looking for the ability to predict a company's revenue, because we're getting paid back as a percentage of the revenue until the loan is paid off. So we have to be able to predict their revenue. So we're probably not going to fund a lot of life science companies, or companies that, have to make a lot of investment until they start seeing some recurring revenue. But it has historically been a really good fit for B2B SaaS companies. Lighter was the first one to really do B2B SaaS revenue-based financing at scale. We started in 2010, and we've done over 1,000 rounds of financing now. So that's one category of companies that take revenue-based funding from us. And what we're seeing more in this market is typically a company, if they went down the venture path, if they maybe started with revenue-based financing and then went down the venture path, which is very common also. In fact, one of the things that Lighter does, we're very well connected in the domestic venture capital market and very well connected in the international, the US venture capital market as well. So one of the things that we do when our portfolio companies are ready to raise venture money, or they decide they want to go down that path, we'll help them, we'll give them advice on the deck, and then we'll help them with warm introductions, which is, helpful when you're going out to raise money. But what typically when a company would go down that venture path, they were on it. They were on a different path. They were raising large sums of money. And what we're seeing in a market like today's is there's a lot of companies that are already venture backed that are doing well, but they're coming to lighter capital for revenue-based financing because they don't want to go out and do a priced round. They either don't want to take the time, it can take months, even a year to get a venture round done. And they don't want to potentially take a down round, which is, it's not great for company morale. It's not great for your current investors. So to the extent that, companies can avoid a down round, they try to do so.
Yeah. And I suppose that was going to be my next question is you're VC funded or you're angel funded, you're getting, I guess, momentum. But in a bull market, you may have been able to value the business significantly higher and therefore raise. In the current market, as you say, you may have to, in order to raise, consider a down round. If that doesn't sound particularly palatable, then the alternative is largely to borrow the money. That seems like a reasonable assumption on the basis you pay it back and ride out the downturn?
Yeah, absolutely. I mean, if you're still looking for growth capital, you still want growth capital because, I mean, you think about, I always say if you know that you pour water on something and it grows, you should just get as much water as you can. I mean, things that early stage companies deal with is, they can pour a lot of water on things and they don't necessarily grow. So they're not exactly sure where to invest. But once you've figured out where to invest, you should get as much capital as you can to invest it, as long as there's positive unit economics, but you should get as much capital as you can. So if capital gets really expensive, like it is today in this current climate, then this is a good alternative for companies that are already venture backed. And then it's also an alternative for companies that, a lot of our customers, like I said, we've done over 1,000 rounds of financing. A lot of lighter capitals customers just don't want to give up equity and don't want to give up control. Control is almost a bigger piece of it. When you take money, like I said, I was a venture capitalist for a long time. When you take money from venture capitalists, you are giving up some control. You're giving up control over when and how much you can raise in your next round, when you can sell. You're bringing someone on to help you set strategy, which can be really helpful, or it can be neutral, and it can actually be harmful too.
Yeah, right. So you're looking for funding that doesn't necessarily come with an equity share and or loss of control. This is an alternative.
Exactly.
So then, on that path, you're a founder, you've proven market, you're looking to scale. This is one of the options, or potentially there's others. What are some of the mistakes you're seeing people make in this space?
On the founder side or the investor side, or both?
Either or. Let's start with founders.
On the founder side, there's lots. In hindsight, it's easy to point to the mistakes, right? But one mistake I've seen a lot is companies who do have to go down the equity and the valuation path because they maybe, revenue-based financing isn't an alternative for them because they don't have revenue, or they need more money than they can get with revenue-based financing. I mean, we can essentially fund 4 to 6 times monthly revenue. So if you think of a company doing $1 million in revenue, we could give them maybe $350,000. But if you're doing $1 million in revenue and you want $10 million to grow, you're going to need to go to venture. You wouldn't be able to support debt with $1 million in revenue and a $10 million in debt. So one of the mistakes that I've seen that happens fairly frequently, especially with first-time entrepreneurs, is that they will focus exclusively on valuation and sometimes raise a little bit of money from, maybe it's a less sophisticated investor who will give them a really big valuation when they're really early. And then when they maybe made some nice progress and they go to raise again, and now they're sitting with this really high valuation before, and it's going to be hard to raise the next round because nobody wants to do a down round. So that makes it difficult. Now, this market's a little different because a lot of companies that have done really well and raised at rational valuations for what was rational a year ago are still going to be faced with down rounds simply because the market has shifted. And then getting the right partner, that's something that has hurt a lot of companies I've seen in my, experience, where if you don't have the right co-founder, sometimes the separation can work really well. A lot of times it can be, it can kill a company.
Right. And what about on the investor side? Are you seeing much there?
On the investor side, I think, look, the best investors are really there to support the founder and the founder's vision and help the founder achieve that vision. And I've seen investors, especially when you look at sort of the 2000s after the dot-com crash and the global financial crisis, where, companies maybe had multiple investors, multiple VCs on their board, and the VCs had really different liquidity time horizons. And that can be quite damaging for the CEO. The CEO of a startup, they're doing, the hardest job in the world already just to try and grow their business. And if you've got people on your board who have control and have a say, advising you to go in different directions. They're not even aligned. That's probably what I've seen be the most damaging for companies. And in this nice bull market we've been in for the last decade, you don't see that as much. Everyone's pretty happy when things are going well and you're having up rounds. But when things aren't going so well, VCs are struggling too with their LPs. You can see lots of different behavior.
Right. And then conversely, what are some of your tips for, founders and leaders seeking to raise, whilst avoiding a down round?
Well, revenue-based financing helps avoid a down round. So if they're a fit for revenue-based financing, our application takes under 10 minutes. You get money within a couple weeks. So it's a pretty easy process for companies that fit. And I think I said earlier, to fit, you'd have to have at least 200,000 in annual revenue, multiple customers, probably low customer churn. We're looking for the ability to predict revenue. And, try to make sure you're going to be alive for the next couple of years. We don't know how long this will last. It could be a blip just because there's a lot of dry powder. There's not a lot of great signs for the economy right now, but there's a lot, like we said earlier, there's more VC dry powder than there has been in the history of the world right now. So when things settle a little bit and valuations, come out of the stratosphere, where they really were for the last few years, then we might see an easier path for companies to raise from venture if that's the path they choose to go down.
So I think it might be useful. We've talked about revenue-based financing a couple of times. I think most listeners are probably familiar with, angel investing in VC and whatnot, but I think this might be a concept that's maybe not as well understood. Could you spend a little bit of time just helping us unpack what the process looks like and how it works?
Yeah. So like I said earlier, the application process is really simple. It's like 10 minutes if you're a slow typer. Lighter capital, we look at the data. So we look at the banking data and the accounting data and to try and get a picture of what's going on with the company financially in order to determine, one, if it's a fit for our type of financing, and two, how much we could fund, and then what the risk profile is. So our typical loan is for 3 years. We'll provide funding for a year if a customer wants it, or even shorter. I mean, the shorter the duration, the less risk it is. But usually entrepreneurs want money for longer periods of time because it gives them the time to actually deploy that capital and see the growth from that capital. So our typical loan is for 3 years. So what we do is we will say, we'll give you $1 and you're going to pay us back, depending on your risk profile, over 3 years, $1.35. So I'll say, here's $1. You owe us $1.35 in the next 3 years. And you're going to pay us a percentage of your cash collected revenue until that $1.35 is paid off. And we're predicting what we think your revenue is, and we're predicting we're going to get paid off in 3 years. If you grow a lot faster, you might pay us back faster, and that's great for us. And it's not worse for you because you're not ever paying us back more than that $1.35, but you're just paying us back faster. And if you, grow slower or go out of business, we might lose money. But it's our product's very aligned with the entrepreneur because the entrepreneur is paying us a percentage of their cash collected revenue. So they're not in a situation, and it's a small percentage, it's usually just depending on how much they've borrowed from us. It's anywhere from maybe a couple percent to, I think the high gets to maybe, 12 or 13% or something, but typically it's under 10%. So it's a small percentage of their cash collected revenue. So they're not in a situation where you've got a big loan to service and don't have the cash. And it also works quite well for companies whose revenue is seasonal. We have a lot of ed tech companies where, they're typically collecting twice a year. So, twice a year, they might have a big loan payment because 10% of what they've collected is a big number. And then the other months, it's very small. And it really works out well for companies who want that downside protection. And we saw this with COVID, where we had some of our companies, their revenue contracted significantly in COVID. Companies in the travel space, we had companies in the ticketing space. One I always bring up is in the lunch delivery space. They had a really good business going, and they were delivering lunches to offices. So through no fault of their own, their revenue went down 90%. And the amount they paid us went down 90% because we were getting a percentage of their total revenue. We had a similar situation with a ticketing company. Their revenues went down 88%. And they were able to scale back, hunker down, while nobody was going to events. This is a US company, and then scale up. And now they were on a rocket ship pre-COVID, and they're back on that rocket ship now. But for a while, they didn't have a lot of revenue. They hardly had any revenue because people weren't going to events. But if they had a typical loan, they potentially could have gone out of business because they would have had this big payment to make and without revenue coming in to make the payment. But because their loan was revenue-based financing and it was a small percentage of their revenue, they were able to weather the storm. So it's very good from that downside protection.
So effectively offloaded some of the risk of that occurring onto you guys.
Yeah, absolutely. And then the reward too. I mean, again, we never get paid back more than the amount, but if we get paid back faster, that's better for us. So if a company gets acquired, 14 months after we made the loan, that's great because then we're getting our money back in 14 months instead of in 36 months. And it's also great for the company, typically, if they got acquired.
Great for everybody by the sounds of it.
Yeah. No, it really is. I mean, I was an entrepreneur. I ran a couple companies that both had successful exits, and then I was a venture capitalist, an angel investor, and I've been running Lighter for a little over a couple of years now. And one of the reasons I went from the board to running the company that I wanted to do this is because I absolutely love our product. I've never been involved in a company whose customers love them this much. And I get it. I get it from, the time I spent as an entrepreneur raising money, which is really difficult, and the time I spent as a venture capitalist saying no all the time. Venture capitalists say no 99 times for every one time they say yes. Most of the time it's to really good people and good companies, but it just doesn't fit. So what's nice about this model is we say yes to every company that fits our model. And if it doesn't, we tell them why. Maybe their churn's too high, their margin's not high enough, but it's, there's really hardly anything subjective that goes into our decision making. So it's a lot nicer for the entrepreneur raising money where, I know when I was getting no's from VCs, there was never really a clear reason.
And I suppose you'll never necessarily be close enough to their investment hypothesis to understand why anyway.
Well, even their investment hypothesis, even as a VC, you're still going to say no to most companies that, would meet the criteria. I mean, as a VC, that was kind of the hardest thing for me, especially at NAB when I was a managing partner at NAB Ventures. We had on our website, this is what we look for, fintech, strategic fit to the bank, blah, blah, blah. And, sometimes entrepreneurs would say, we meet all this. Show me which one of these bullet points we don't meet. And, it's like, well, you do, but, we're only going to do so many deals every quarter, 2 or 3 deals every quarter. And there's, 20 that meet it more than you do, or 20 that are maybe a stronger strategic fit, or, so versus, at Lighter Capital, there's no limit to the number of deals we would do. If they fit our criteria, we'll do them all. So,
Melissa, this has been fascinating. I want to thank you for spending the time to help us unpack this. Melissa, thanks for your time. We'll talk again soon.
Okay, thank you.
You've been listening to Platform Diaries with Shane Williams. To find out about how Shane enables digital businesses to scale, please visit shanewilliams.com.au. Thank you for listening.